What's up, team? Sean from Rest to Live here, and I got a comment the other day asking for a quick, brief synopsis on a REIT versus an actual rental property. Why one might make sense, one reason why another might not. Sort of that kind of a play here. And as always, I try to make videos on what you guys are looking for. So without further ado, let's not waste any time. I'm going to jump right on in here. The one thing I'm going to ask, and I don't normally do this, is if you're coming to this channel on a regular basis, we'd really appreciate it if you hit the subscribe and like button. We are getting continuously pushed off the algorithm, which is really making it tough to get anyone to see these when they're new. So if you could do that, I'd really appreciate it, but no big deal if you can't. I understand. So let's jump right in. Let's not waste any time. I actually put together a little presentation here because I thought this would be a really interesting topic. So let me just share my screen. And what I want to do is put this right into present mode because, I put a little work into this, as you can see here. So I think it's a really basic question. What is the difference when we're talking about real estate in terms of, is one better than the other? When should we think about one versus the other? What are the reasons why you might go into these different pieces? So the question is simple: real estate, REITs versus rentals. Excuse me. So I guess the first thing we want to start with is that there is no right answer here. I'm going to do a little bit of a comparative analysis, but it's going to be very dependent on a lot of things that I won't know about, but you will. So for instance, you might want to get into rental properties that you're going to own, finance, and rent out. And then your goal is to try to collect rent and make money on them. But, there's considerations for those. Now, conversely, you might find it easier to jump into REITs. A REIT is a real estate investment trust. It's traded on the public markets. It's also traded privately as well. But for the purposes of this video, we'll really be thinking more about the publicly traded versions. So let's take a look at each one here. And we're not going to make this a long, drawn out video either. So in terms of the considerations before we get into the actual differences between the two, I want to call this out because I think it's important. Whether we're talking about physical real estate that you will own, or we're talking about REITs that you will invest in, there are different types of things we can look at. There's residential properties. I wanted to make this as simple as possible. So this is where people will live. This could be a single family. It could be a condo. It could be a multifamily with 10 units or a multifamily with 1,000 units. But when you think residential, think people live in the units. We then have commercial properties. I really wanted to designate commercial properties as any other type of property beyond residential. It could be a bowling alley, an office building. It could be a sports facility or a church that's being rented out. It could be industrial. It could be for food service. So any kind of property other than residential, I'm putting under commercial property for sort of the terminology here. And the other thing I just want to call out too for future reference is if we're talking about property and portfolio management, these are considerations as well, because the fees you will pay both within REITs and within real estate, right, or hard real estate that you'll own, is that the costs can vary wildly. So depending on where they are, how many units you have or how many units the REIT has, the level of complexity in the contracts, leases, and maintaining of them can really determine what kind of cost you experience, when it makes sense to have a property manager versus not, what you can expect to pay, as well as the overall costs for managing your property, right? It could be looking at things like how much do you take out for CapEx, how much do you take out for maintenance, what comes out for vacancy. So it's important when we're thinking about this that it's not as simple as just one or the other. There's lots of reasons to really dive in deep and understand the type of property, the considerations that will then flow therein too, and the way you think about managing it from a cost perspective, okay? Excuse me. Now, let's jump in real quick here, right? When we're thinking about REITs, I'm trying to get this picture moved out of the way. It keeps moving on me. We're thinking about REITs. I want you to really think about three key things, and I'm going to tell you a quick story here as well. REITs are real estate investment trusts. For the purpose of this video, we're talking about those that are publicly traded on a major market. So think New York Stock Exchange or the NASDAQ as an example. Now, you can find REITs that are private. You can find REITs that are registered with the SEC, but still private. It's important to understand that distinction, but for this purpose, we're talking about something you could go into your broker and easily buy. So there's three main things I want to really call out here. Number one is liquidity. Liquidity is the ability to get your money in and out of an investment very quickly if you were to need that money, right? So REITs are easy to buy and own. They're also relatively low cost. Most REITs that are out there for the purposes of this video can be bought on a Robinhood app with $1. Or you can buy them by the share. You can buy 1,000 shares, right? It doesn't matter, but it's the ease of use of getting into them. Now, the other big call out for REITs is it is truly a passive real estate investment. Okay. The idea here is really profiting without stress. So you, as the owner of a REIT or share of a REIT, you have no need to physically own, manage that property, worry about financing that property, looking at refinancing, bringing people into fixed problems. You're simply owning a share of the company that owns all the real estate. You collect that in the form of our next point, strong dividends. So REITs are required to pay all profits out, or up to, at least 90% of profits to shareholders. So the reason this is important is they need to constantly be taking that rent and sending it right back out to you in the form of a dividend. So typically speaking, and the key word here being typically speaking, REITs do pay higher yields than most investments. Now, I want to call this out that there are considerations on the way they're taxed. And you have to be careful when you jump into these that they're treated a certain way and taxed a certain way. So you're not anticipating income that you're going to then owe taxes on. So just wanted to call that out for a second here. So in a nutshell, let's repeat that, right? REITs are easy to buy and sell. You don't have to worry about anything regarding the actual real estate. And typically they have really strong dividends or dividend yields. And there are all kinds of REITs, by the way. There's single family REITs, multifamily REITs. There's commercial property REITs, industrial REITs. There's office space REITs and retail REITs. There's mixed and blended REITs. And then there's also mortgage REITs, or what will sometimes be called MREITs, MREITs. These are for investment trusts that put their money into the actual financing of real estate. And sometimes you'll have blended where it's a REIT with an MREIT. So that's in a nutshell, right? It's pretty simple, nothing too complex here. So the next piece of it is really thinking about rentals, right? What are the benefits of owning rentals after you just heard all that great stuff on the other page here? Well, it's really simple. We're looking at cash flow and appreciation in excess of what we would get with just owning a REIT. So as an example, if you own a REIT, perhaps you end up with a yield of 3, 4, maybe 5% if it's a particularly good holding. With rentals, you can really see return on investments of 10+% depending on how you buy, where you buy, and your ability to force that cash flow. What that means is I can go in and upgrade the property. I can make it nicer. I can seek a higher rental market because I've improved my property and I got asked for higher rent. That higher rent will equate to more cash flow if I kept all of my financing the same. The other piece as well is the appreciation piece. That underlying piece of real estate typically over time does increase in value. All markets, especially real estate markets, will see ups and downs over the long haul. But for the most part, it's always going to be going up long term. The further you scale out the timeline, the more vertical it seems to really become. So the beauty of this is you have the ability, since it is your property, to do these things. You can make those repairs. You can take advantage of ways to increase the cash flow. There's a whole myriad of ways to do this. It's too long for this video, but I just want to call that out. The other big piece of this is the tax advantage perspective of owning rental properties. So you can write things off like real estate taxes, depreciation of the property, the interest you're paying for your financing, your CapEx costs, your maintenance costs, any money that you spend to keep, run, and own that property, you're going to typically be writing off as an expense of the business. And this will include property management fees as well. So if you have someone managing your properties, whether it's 8%, 10, or 12, that's also going to be a consideration too from that tax advantage perspective. Now, I'm not a CPA, and I don't want this to come across as tax advice because even I get a CPA to help me do my taxes in terms of my rental properties. But I do want to call it out that sometimes when we look at a property, we might assume there's no cash flow. But the reality is a lot of the things that we take out of that cash flow are costs that don't come till later. It could be putting aside money for CapEx down the road, or putting aside money for vacancy, or putting aside money for maintenance. Same with depreciation. Depreciation is the essential wear down of the property that you get to write off over the long term on your taxes as well. This isn't a true factor as far as something you're paying every year, but it's an advantage come tax time that sort of creates a double-sided coin between appreciation on one end and depreciation on the other. Probably the biggest piece for me is around the decision-making process. It's the ability to decide what I want to do with the property. So if I own that REIT and I get my dividend and they decide to sell half their portfolio, or they cut the dividend, or they decide they want to switch their go-to-market, you have no say in that. You can sell it. Perhaps you can vote those shares, but they're going to be minimally important to the overall voting. When you own your own properties, it's up to you to decide what you want to do. You can leverage that property to buy more properties. You can refinance it to lower your rates and increase your cash flows. You could take a cash out because you want to access some of that money within the property. So you have that ability to control and work through whatever you want to do on that front. So I wanted to call it out that there's a lot more control here. One other really big consideration that I didn't write down, but I wanted to share is real estate can be very opportunistic if you can get creative in how you think about acquiring it, finding it, and managing it, and essentially just holding it over the long term, because most people in general are not going to own rental properties. This means that there's going to be opportunities in the market for someone else to come in and get their hands on it. And I think that fear is a driving factor. So because a majority of the market either doesn't have the capital to do it, they are fearful of getting into it, or they generally just don't want the responsibility of it, it means fewer people have an opportunity to get in on these kinds of properties. And that's where you can find some really good deals and make things sort of work in your favor to increase those pieces of it. So sort of a lot there, right, that I covered. Now, here's the reality of it, right? When I really wanted to step back and think about it from a comparative analysis perspective, it's not as simple as comparing apples to apples. I don't even think it's as simple as comparing apples to oranges. It feels to me like comparing apples to light bulbs a little bit, right? Maybe they're both round, but ultimately they're very different things. And I think the true answer here, as far as what makes sense for you, is that it really does depend on your portfolio, on your capital, on your degree of passivity and how much you want to be involved, on your degree of what kind of stress or what kind of opportunities you're looking for. If a 3, 4, 5% yield offers you exactly what you need from an income perspective, seems like REITs would probably be a no-brainer. If you really want to push the limits and try to get a 10, 12, 14% return, well, you're not going to be able to get that with a REIT. You're going to have to try to get that with real estate, actual hard real estate. Now, here's the truth also. They both might be the wrong play, or they both might be the right play. Maybe it makes sense to have neither of these because it doesn't fit your goals or where you're trying to get to. Perhaps what you want to do is own both and let them work with each other. So I want to give you a quick story on how I approach this. And I have a few more things I want to talk about here because I think the important stuff is coming in a second. What I often like to do is I like to invest the rents that I have, my cash flow, into REITs. And it helps me to diversify. So as an example, if I have a portfolio of single family homes and I have cash flow from those, what I'll typically do is I'll take that cash flow after I've taken care of my maintenance holding, my vacancy holding, my CapEx holding, and any taxes that I would have to hold as well. And I'll actually diversify into maybe a triple net lease or some retail or some office or some other types of residential, right? Maybe it's multifamily and I have single families. So this gives me a little bit more income while I'm waiting to buy my next properties. My goal is to try to generate that income and help me grow that holding while it's waiting to be played. Now, of course, there's risk in doing this. I want to call that out. This is not meant to be financial advice. It's literally meant to be an example of what I do. So when we're looking for that yield on capital on the actual piece of real estate that we buy, we're also then looking to acquire additional yield on our cash flow. And this is how we do that. So it allows us to make a little bit more with what we've already made while that money is being prepared to go into the next deal, as an example. So I just want to call that out, that you can get very creative in how you think about this as well. Now, it's easy to think about this from simple terms as far as like, wow, there's lots of great reasons why you might want to do both. There's lots of great reasons why both could potentially be the right thing for you. I want to call this out though, because it's not all good. There are cons to both. So when we think about REITs, what stands out to me is you're not getting the tax advantage, right? So you have to make sure that that's something you're aware of going into it. The other thing as well is if you get into a certain type of REIT and something suddenly changes in the market, you could see large drops in value of that underlying stock that you own. Think the past couple of years with COVID in the market, where office REITs have been absolutely hammered across the board, right? That's something to really be aware of. The other big thing as well is that REITs in general, doesn't matter what type of REIT we're talking about, can be very, very closely tied to interest rate fluctuations because they have to constantly be looking at their portfolio, raising capital, looking for ways to refinance, to move into more different capital markets. There can be an ebb and flow in value as it relates to interest rates. So in a nutshell, you have to deal with not only the macro changes from an interest rate perspective, but also the macro changes as far as a demand perspective, and you have no control over those things. So I just want to really call that out for a second, that there are some negatives to what sounds like a lot of positives. Now, the same can be said for actual direct real estate or real estate that you own in your own name type of deal, right? There is a lot of time and energy that goes into it. Although you will hear a lot of folks, and I'm a big proponent of this as well, if you treat it like a business, you hire the right people, you hire the right team, it can be very easy to own real rental properties. It is absolutely not 0% no work, or 100% no work rather. It is not truly passive. Now, truly passive means I put $100 in the market, it makes 4% yield, I get $4 a year on that, right? That's passive. If I have to deal with property managers, if I have to deal with attorneys, if I have to deal with realtors, if I have to deal with the banks, even if it's only a couple hours a month, it's not truly passive. So keep that in mind. There's also other considerations, right? You can run into issues with your financing. It can be hard to get the money you need. Coming up with down payments in a changing market can create issues. Right now, we're dealing with historic changes in underlying interest rates. Now, not historic as in all-time highs, but sort of how fast things seem to be moving. So if you suddenly were in a property that had a 5-year term and need to be refinanced, well, are you going to be in trouble if you go from a 4% to an 8% yield out of nowhere? Does that eat up all your cash flow and take away any profits you might have? It's very possible. The other real big consideration I think that too many people don't think about with hard real estate, right, is it's very, very illiquid. And what I mean by that is you put that money in and you may not be able to get that money out for a long time. Now, that's not a bad thing inherently, but you don't know what can happen. And if you eat up all the cash and capital that you have to buy your first rental property, and then anything happens, your car craps the bed, you lose your job, you have any other health issue, anything, right? Imagine any scenario. You can't just suddenly go and pull that money out and say, I changed my mind, sell it. You're going to take massive losses, or you won't be able to sell it at all unless you lower the prices immediately. So just keep that in mind, that liquidity does have value, and it's very hard to measure that value because you don't know what can come down the road. So look, that's it in a nutshell. I wanted to keep it really simple and straightforward here. I don't normally put this stuff out this late at night. That's why it's a little bit dark in here. But I just want to share this because I think there's a lot of folks out there who are really stuck between what should I do and how should I move forward. And I think there's a lot of considerations to make, but there's just those key things to say to yourself, right? Do I want to manage it myself, even if I have a property manager, or do I want truly passive? Is a 4% yield going to get me excited, or I really want to try to get that 10% yield, but deal with what comes with that? Will I need the money in the near term? Will I not need the money for a long period of time? Lots of ways to think about it, lots of ways to analyze it. I have a simple ask. Let me know down below in the comments what you prefer. Is it a REIT? Is it a rental? Or is it both? I really appreciate everyone watching as always. Thanks so much, and I appreciate your support. Team, have a great night and good luck out there. Thanks, everybody.